Hello everyone. The topic of this video discussion is the Tax Cuts and Jobs Act summary for some business changes. I actually recorded a video of a summary for individual changes as well. But in this particular video, I'm just going to cover some of the what I think are important changes relating to businesses under the Tax Cuts and Jobs Act, TCJA, President Trump's tax reform, new tax law, whatever you want to call it. But anyway, I'm going to be reading from a document that I have that summarizes some of these changes. So every now and again, I'm going to turn away from the screen here and look down and read, because I wasn't about to try to memorize this stuff. I already have enough tax jargon in my head. Don't really need to put any more up there. So anyway, let's get started here. And again, this is some of the changes affecting businesses under the TCJA. And for the most part, most of the changes are applicable for tax years 2018 through 2025, December 31st, 2025. December 31st, 2025 is when some of the changes under the TCJA sunsets, goes to sleep, goes away. After that date, things revert back to what they were prior to the TCJA going into effect. Okay, so let's get started here. Changes for corporations. Well, now corporations, including PSCs, personal service corporations, now pay, well, not now, but under the TCJA for tax years 2018 through 2025, they will pay a tax rate of 21% as the corporate tax rate. And regarding corporate AMT, prior to the TCJA, the corporate AMT was imposed at 20%, at a 20% rate. However, corporations with average annual gross receipts of less than $7.5 million for the preceding 3 years were exempt. For tax years beginning in 2018 or later, the new tax law repeals the corporate AMT. For corporations that paid the corporate AMT in earlier years, an AMT credit was allowed under prior law. The new law allows corporations to fully use their AMT carryovers in their 2018 through 2021 tax years. Next on the list is the reduced corporate dividends deduction. Under pre-TCJA law, C corporations that received dividends from other corporations were entitled to partially deduct those dividends. If the corporation owns at least 20% of the stock of another corporation, an 80% deduction applies. Otherwise, the deduction is 70% of dividends received. For tax years beginning in 2018 or later, the TCJA reduces the 80% deduction to 65% and the 70% deduction to 50%. Okay, so next I'm going to talk about this new deduction for pass-through businesses that's seeming to be a buzz all over the place. Okay, so under pre-TCJA law, net taxable income from pass-through business entities such as sole proprietorships, partnerships, S corporations, and single-member LLCs that were treated as sole partnerships or as part of partnerships for tax purposes was simply passed through to owners. It was then taxed at the owner's standard rates. In other words, no special treatment applied to pass-through income recognized by business owners. So for tax years 2018 through 2025, the TCJA establishes a new deduction based on a non-corporate owner's qualified business income, QBI. This break is available to individuals, estates, and trusts that owns interest in pass-through business entities. The deduction generally equals 20% of QBI, subject to restrictions that can apply at higher income levels. QBI is generally defined as the net amount of qualified items of income, gain, deduction, and loss from any qualified business of the non-corporate owner. For this purpose, qualified items are income, gain, deduction, and loss that are effectively connected with the conduct of a U.S. business. QBI doesn't include certain investment items, reasonable compensation paid to an owner for services rendered to the business, or any guaranteed payments to a partner or LLC member who is treated as a partner for services rendered to the partnership or LLC. The QBI deduction isn't allowed for calculating the owner's AGI, but it reduces taxable income. Let me say that again. The QBI deduction isn't allowed in calculating the owner's AGI, but it reduces taxable income. So in effect, it's treated the same as an allowable itemized deduction. Okay, so let's talk about the W-2 wage limitation. For pass-through entities other than sole proprietorships, the QBI deduction generally can't exceed the greater of the owner's share of 50% of W-2 wages paid to employees by the qualified business during the tax year, or the sum of 25% of W-2 wages plus 2.5% of the cost of qualified property. Qualified property is the depreciable tangible property, including real estate, owned by a qualified business as of year end and used by the business at any point during the tax year for the production of qualified business income. Under an exception, the W-2 wage limitation doesn't apply until an individual owner's taxable income exceeds $157,000 if filing single, or $315,000 for joint filers. Above those income levels, the W-2 wage limitation is phased in over a $50,000 range, $100,000 for joint filers. All right, next is service business limitation. The QBI deduction generally isn't available for income from specified service businesses, such as most professional practices other than engineering and architecture and businesses that involve investment type services such as brokerage and investment advisory services. Under an exception, the service business limitation doesn't apply until an individual owner's taxable income exceeds $150,000 filing single, or $315,000 for joint filers. Above those income levels, the service business limitation is phased in over a $50,000 phase-in range, and again, $100,000 for joint filers. Okay, let's talk about business interest deductions. Subject to some restrictions and exceptions, under pre-TCJA law, interest paid or accrued by a business generally is fully deductible. Under the TCJA, for tax years that began in 2018 or later, businesses generally can't deduct interest expenses in excess of 30% of adjusted taxable income. For For S corporations, partnerships, and LLCs that are treated as partnerships for tax purposes, this limit is applied at the entity level rather than at the owner level. For tax years beginning in 2018 through 2021, adjusted taxable income is calculated by adding back allowable deductions for depreciation, amortization, and depletion. After that, these amounts aren't added back in calculating adjusted taxable income. Business interest expense that's disallowed under this limitation is treated as business interest arising in the following taxable year. Amounts that cannot be deducted in the current year can generally be carried forward indefinitely. Taxpayers, other than tax shelters, with average annual gross receipts of $25 million or less for the 3 previous tax years are exempt from the interest deduction limitation. Some other taxpayers are also exempt. Let me say that again. Taxpayers, other than tax shelters, with average annual gross receipts of $25 million or less for the 3 previous tax years are exempt from the interest deduction limitation. Okay, so let's move on to depreciation, and we're going to talk about bonus depreciation here. Under pre-TCJA law, for qualified new assets that your business placed in service in 2017, you could claim a 50% first-year bonus depreciation deduction. Used assets don't qualify. This tax break is available for the cost of new computer systems, purchased software, vehicles, machinery, equipment, office furniture, and so forth. In addition, 50% bonus depreciation can be claimed for qualified improvement property. Bonus depreciation improves significantly under the TCJA. For qualified property placed in service between September 28, 2017 and December 31st, 2022, or by December 31st, 2023 for certain property with longer production periods, the first year bonus depreciation percentage is increased to 100%. In addition, the 100% deduction is allowed for both new and used qualifying property. The new law also allows 100% bonus depreciation for qualified film, television, and live theatrical productions placed in service on or after September 28, 2017. Okay, so in later years, bonus depreciation is scheduled to reduce as follows. 80% for property placed in service in 2023. 60% for property placed in service in 2024. 40% for property placed in service in 2025, and 20% for property placed in service in 2026. For certain property with longer production periods, the preceding reductions are delayed by 1 year. For example, 80% bonus depreciation will apply to long production period property placed in service in 2024. Also, be aware that under the TCJA, in some cases, a business may not be eligible for bonus depreciation beginning in 2018. Examples include real estate businesses that elect to deduct 100% of their business interest and dealerships with floor plan financing if they have annual gross receipts of more than $25 million for the 3 previous tax years. Okay, moving right along to the Section 179 deduction. When 100% first-year bonus depreciation isn't available, the Section 179 tax break can provide similar benefits. Section 179 allows eligible taxpayers to deduct the entire cost of qualifying new or used depreciable property, most software and qualified real property improvement in year one, subject to various limitations. Under pre-TCJA law, for tax years that began in 2017, the maximum Section 179 depreciation deduction was $510,000. The maximum deduction is phased out dollar for dollar to the extent the cost of eligible property placed in service during the tax year exceeds the phase-out threshold of $2.3 million. The TCJA permanently enhances the Section 179 deduction. Under the new law, for qualifying property placed in service in tax years beginning in 2018, the maximum Section 179 deduction is increased to $1 million, and the phase-out threshold amount is increased to $2.5 million. For later tax years, these amounts will be adjusted for inflation. The new law also expands the definition of eligible property to include certain depreciable, tangible personal property used predominantly to furnish lodging. The definition of qualified real property eligible for the Section 179 deduction is also expanded to include the following improvements to non-residential real property: roofs, HVAC equipment, fire protection and alarm systems, and security systems. Okay, so let's talk about deductions for business passenger vehicles. For new or used passenger vehicles that are placed in service in 2018 and used more than 50% for business, the maximum annual depreciation deductions under the TCJA are as follows: $10,000 for year one, $16,000 for year two, $9,600 for year three, and $5,760 for year four and thereafter until the vehicle is fully depreciated. Okay, so let's talk about the changes with the meals, entertainment, and transportation. Prior to the TCJA, taxpayers could generally deduct 50% of expenses for business-related meals and entertainment. Meals provided to an employee for the convenience of the employer on the employer's business premises were 100% deductible by the employer and tax-free to the recipient employee. Various other employer-provided fringe benefits were also deductible by the employer and tax-free to the recipient employee. Under the new tax law, for amounts paid or incurred after December 31st, 2017, business-related entertainment expenses are no longer deductible. Let me say that again. Under the new law, for amounts paid or incurred after December 31st, 2017, business-related entertainment expenses are no longer deductible. Meal expenses incurred while traveling on business are still 50% deductible, but the 50% disallowance rule will now also apply to meals provided via an on-premises cafeteria or otherwise on the employer's premises for the convenience of the employer. After 2025, the cost of meals provided through an on-premises cafeteria or otherwise on the employer's premises will be non-deductible. Again, after 2025, the cost of meals provided through an on-premises cafeteria or otherwise on the employer's premises will be non-deductible. The new law also disallows employer deductions for the cost of providing commuting transportation to an employee, such as hiring a car service, unless the transportation is necessary for the employee's safety. It also eliminates employer deductions for the cost of providing qualified employee transportation fringe benefits, for example, parking allowances, mass transit passes, and van pooling. But those benefits are still tax-free to the recipient employees. Now, some other changes that were made under the TCJA are as follows. The Section 199 deduction, also commonly referred to as the domestic production activities deduction or manufacturer's deduction, is eliminated for tax years beginning after December 31st, 2017. For non-corporate taxpayers and for tax years beginning after December 31st, 2018 for C corporation taxpayers. For businesses' net operating losses, NOLs, that arise in tax years ending after December 31st, 2017, the maximum amount of taxable income that can be offset with NOL deductions is generally reduced from 100% to 80%. In addition, NOLs incurred in those years can no longer be carried back to an earlier tax year except for certain farming losses. Affected NOLs can be carried forward indefinitely. Again, affected NOLs can be carried forward indefinitely. A new limitation applies to deductions for excess business losses as well, incurred by non-corporate taxpayers. Losses that are disallowed under this rule are carried forward to later tax years and can then be deducted under the rules that applies to NOLs. This new limit kicks in after applying the passive activity loss rules. However, it applies to an individual taxpayer only if the excess business loss exceeds the applicable threshold. The eligibility rules to use the more flexible cash method of accounting are liberalized to make them available to many more medium-sized businesses. Also, eligible businesses are excused from the chore of doing inventory accounting for tax purposes. The Section 1031 rules that allow tax-deferred exchanges of appreciated like-kind property is allowed only for real estate exchanges completed after December 31st, 2017. Beginning in 2018, there are no more like-kind exchanges for personal property assets. I'll say that again. Beginning in 2018, there are no more like-kind exchanges for personal property assets. However, the prior law rules still apply if one leg of an exchange has been completed as of December 31st, 2017, but one leg remains open on that date. Compensation deductions for amounts paid to principal executive officers generally cannot exceed $1 million per year, subject to a transition rule for amounts paid under binding contracts that were in effect as of November 2nd, 2017. And specified research and development, R&D, expenses must be capitalized and amortized over 5 years or 15 years if the R&D is conducted outside of the United States instead of being deducted currently. This goes into effect for tax years beginning after December 31st, 2021. Okay, well, this concludes my discussion on the topic of the summary of changes for businesses under the Tax Cuts and Jobs Act. And my goal is to help you make your life a little less taxing. And I hope that the information provided in this video certainly will help to do that. Thank you for listening.